Hello, I want to welcome you to the investing course in Selection. In this course, we're going to be covering a lot of different investing materials and how to value good companies and how to take advantage of what the stocks are giving you, in which you could decide whether it's a good time to invest or not and how to take in profits. Right. So, talking primarily about that, there's a bunch of different materials online on investing, right? But 90%, more than 90% of everyone who talks about investing has to do relative to stocks, has to do relative to formulas, and how to take in many ludicrous amounts of formulas and numbers and calculating how much the stock returns in 4 years and 3 years, and then figuring out with that calculation how to see the output in 8 to 10 years. I think a lot of people do that. But what makes this course different is I've learned from the best investors in the world, people like Peter Lynch, Warren Buffett, Ray Dalio, um, Mark Howard, Lee Lu, Manish Babrai, and Joel Greenblatt. Like just many different investors all have something in common within those type of investors, right? So what's the thing in common? Both of them invest based on what the business fundamentally is showing, and that ultimately dictates to how much and whether they would invest in the company or not. Each of them have different sorts of ways of, let's say, specifically how they invest, but those are the things that share in common. Now, what I do is I've mixed all these type of investors methodologies and formulas and sort of created my own based on my own experience. I primarily invest in companies, not the stock. So this is where I don't know, many people who are going to be watching this are going to have different ways to look at the stock market, and probably they've already learned how to invest, but they're probably not getting good results. There's just, or people don't know anything about the stock market. I think this is going to range around many different scenarios, but that's perfectly fine, right? What I want you to understand is in stocks, in the stock market, the reason why 99% of people aren't successful in the stock market is because they project the stock market, or they outview the stock market incorrectly for their expectations. So you have to fix first the expectations, and then that fixes your results. That could ultimately dictate whether you can be consistent or not. It's a very psychological game. It's the same thing as trading in terms of psychology, right? In investing, I'm going to tell you right off the bat, you have to have a very strong psychology. Investing it does not take you to be smart in investing. No, you do not have to be smart to be consistent. You have to be very logical, and you have to think in ways and where other people and where others aren't thinking that scenario. You have to constantly think of risk. You have to constantly think of areas that people don't want to go to, and you have to be disciplined and consistent to find areas whether the business is not doing well or doing well in a shrewd manner. You have to. It doesn't mean that you're going to be looking at the company every once a year, but you're going to be very quick in making decisions in the companies that you're investing, because you're really paying attention to it, not ignoring that, oh, little one thing bad happens and you don't think that will affect the stock as much or the company as much. Most of all, the company. You can't have that mindset. You have to factor in many different areas, because it's an instrument, it's an asset, it's a long-term asset, but you cannot ignore important facts, because that's a key player where many investors fail after they've done so well, because they get lazy. They think they're doing so well, and they think they will do well because they simply think, but they don't put that in action. They're not staying as disciplined as when they were starting, right? And I don't want you to be that, right? This is a completely psychological game. You have to do the opposite of what everyone's doing, right? If everyone's buying, you're not going to be buying as much. If everyone's selling, you're going to be the one buying. I want you to put this in your brain as you start in this course, because everything that we're going to do is going to be based on that. We're going to be buying really when no one's buying, and we're going to be selling when no one is selling. Although really it depends on the way of how you're investing. I never sell. The way how I've learned the best is, if you want to grow your wealth in investing, you never want to sell, depending what you're holding, of course. But the whole point is to hold the best quality companies as possible. Therefore, you won't sell, right? You won't sell unless fundamentally something changes in the company. Most of you might be thinking, why does everyone then view the stock market as not in this manner? Why do people invest based on charts or based on how much the return is in 2 years or 3 years? The primary reason is because a lot of big investors before have promised, let's say, these sort of outlooks, right, in Wall Street. I don't agree with Wall Street in their manner. There's a few similarities in which I do with Wall Street does, but I do almost the opposite of Wall Street because unfortunately, Wall Street, as you guys know, if you guys done my trading course and my option course, if you did do the trading courses, you guys know really the outlooks of Wall Street for me, right? For Wall Street investors I'm not saying for all of them, right? There's a lot of Wall Street investors who are really well, but the problem with Wall Street, I'm talking about the general investor, I'm not talking about specifically, but I'm talking about the general, is that they get heavily influenced by many different information. The problem with Wall Street is that there's too information, and because of this information, they find it's easily more returnable to provide information rather than to provide better product outlooks, if that makes any sense. So they find it better to sell information rather than to find good companies and invest in them. If you look at Wall Street Journal right now, there's going to be ludicrous amounts of different companies every three months that they think is going to do really well. Really, but that's, they're selling you, right? That's not, unfortunately, that's the game of Wall Street. That's what a lot of hedge funds do. When you put your money in a hedge fund, it's very similar to a bank. They circulate your money and then they invest that money into attractable assets. But the problem is that when there's more funds, you have to keep up with expectations of people funding you. And overall, those returns, because you have more funds, are going to be lower, in which you need to promise consistent returns where it's impossible to do that. So because it's impossible, they're going to make a business structure in where the amount that you're going to fund, they're going to give you that return, but really the return that they're making, similar to a bank, is increasing more and more and more because you're invested. So basically, they're going to be charging you more interest. They're going to charge you a higher interest, and you're not going to get as better as a return compared to what they are getting in return. If that makes any sense. That's the problem with Wall Street, with mutual funds and hedge funds, and investing your fund into an IRA. I'm talking about primarily if someone manages your funds. That's why I don't believe in that stuff. That completely depends on preference. But I want you to think very logically of how you're allocating your funds at all times. Whether this is a good investment, whether that person's making a better investment than you, or completely depends if you don't know how to. Well, that varies, right? So I want to go through that. In the stock market, people look at Wall Street or a lot of others who have many good resumes in their colleges and go to Wall Street and they do well, right? But again, this comes with the problem that in Wall Street, there's too much noise. You can't find good investments. You're going to have a lot of investments and therefore that you think logically that is good because you have a lot of resource. Yeah, but there's too much. When you have someone, when you're walking in Wall Street, someone's going to come pass by and keep talking to you what's a good investment. It's going to distort your rationality. It's going to distort your judgment, and that's going to cloud your judgment. Because if you're going to have this mindset where a lot of people are talking about this company, let's go into that. Yeah, but it's the same thing as like when you're going to learn that when many people are buying, it's the same thing. When many people are buying, you hear people want to go into it. That's when it tends to come down. There's no reasons. It already factored in lately. So what you're going to learn in this course is how to find these quality attributes in a business before really that Wall Street person or everyone starts to say that it's a good company. That's what you're going to learn in this course. You're going to learn, which is super vital. I'm not saying that for every company you're going to have this. Your area of competence is going to be different from my area of competence, and it's going to be different from your neighbors, your friends, your family's areas of competence. What's an area of competence? An area of competence is a place where you look at a company and you're competent with it. You understand it very well. It's not hard for you to think. If you're good at automobiles and you know a lot about automobiles and what goes in, and you know the advantages of what consumes more in certain products and how much they can restrain or control the inflows and outflows and how strong their brand is, which regardless of the riskiest scenario, they could still benefit. That's an area of competence. It doesn't mean that this is why it's not that you're smart, right? In order to be really good at investing, based on what I've learned from masters at this, from Warren Buffett too, is you need to become a master at identifying things that people aren't seeing that has to do with the business itself. I want you to erase this thing about a stock, that it's a stock. No, a stock is a business. That's what it is. If I look at Google, if I look at GOOGL, right, that's just a derivative of a company. But why am I investing in Google? Am I investing in it because of the stock? Because it looks like it can return? No, I'm looking at it in the business, because a business affects from what a stock will do. So why would I invest in a stock if the stock is affected from what the business does, right? In the short term, the stock can move relative to what the stock wants to move. But in the long term, the stock's going to be always moved by what the fundamentals are. And this is what 99% of people don't know, because many resources tell them it's not like this, and they don't mention this because it's a selling information platform. That's they make more money selling information than what they do in investments. And I don't want you to do that, right? I don't want you to be caught in that trap. In fundamentals, you will learn how to identify a good company, how to identify a strong company. And I'm really going to cover so much different ways of doing this, because there is no right way, right? There's a lot of people get confused. Even a lot of people are very experienced in investing, that there's an area called value investing. Value investing. Many people think that value investing has to do that, you pick businesses in a way that you hold a very short amount of businesses. You stick with really good companies over a few years, and then you sell them, and then you get into new companies, and then you sell them later, right? There's no specific way of doing value investing. Value investing has to do with what the name is. You're value investing. You're investing in valuable companies. There is no right or wrong way to go about it. I'm going to show you many different ways of how to value invest, and how to ultimately, because the point of investing is to, what you're paying now, later on you will have a higher return for what you pay. I mean, that's you're getting a higher amount from what you pay. That's the whole point of investing. Unfortunately, I think this is such a complex topic that many people always complicate, because this is where the problem comes in. A lot of smart people like to complicate things. They like to complicate it with numbers and formulas based on ignorance, right? When they don't know something, they try to factor it in excuse to what it is, based on the short term, but they don't factor a longer term. And the reason why many people act this way is because the market is extremely abundant, and many different ways to look about it. This is why I love the market too. In the long term, you will always outperform anyone who does things in the short term. That's just a fact. There's a fact. No one else will change this. In the long term, you're always going to outperform anyone in the short term. Even in the long term, as a retail investor, you're always going to outperform any hedge fund, any mutual fund, and even Warren Buffett, Berkshire Hathaway. And many of you might not believe me what I'm saying, but no, it is true, because the retail investor, when you have a smaller amount of money, you have a bigger world. You're able to invest in different companies that are smaller in market cap, but have a high potential of growing their money. I want you to look at businesses as a money-making machine. I want you to look at stocks as a money-making machine in the long term. In the short term, anything can happen. And that's why I don't invest in the short term with companies or anything, because in the short term, anything can happen. The market's influenced by many macro events that ultimately people chase their tail around in circles, and they try to make a higher return with that. You think that there's gold there, but in reality, out of their findings and their mistakes, net overall, they're just going in circles. And that's not what I do. That's why I don't do that. I believe more in the long term. The methodology that I want you to have in your mind is that you're not here to make high extreme amounts of money. I want you to make money for sure. That's the whole point of investing. I want your risk to be as little as possible, depending on your area of competence and depending on the acceleration of how you're going to invest, and ultimately get that money back in the long term. Anything can happen in the short term. You're going to have drawdowns. You're going to have all this, right? But I don't want that to affect you. I want you to look at the logic and say, okay, if the stock has gone down, right? If stock A has gone down, but I see that stock A, its valuation, its company is worth about $100 per share. But let's say the share price went down in 6 months to $50 a share. Would you really be scared to sell $50 a share if you know the company's worth $100? No. If the company drops to $50, what would you do? Would you sell? No, because if you sell, you lose. But then many of you might be saying, yeah, but what if it goes down more? Hell, if it goes down more, even better. Why? Because in the long term, if this company you know that it's going to make more money in 20 years, why would you sell at $50 when you know it's going to be worth, I don't know, like $2,000 in 10 to 15 years? But many people don't see it this way because of emotion. When you see the price going down and you see all these bad news and you see people are getting scared and you see people keep talking about different excuses why the market's going to go down and how everything terrible is, right? All that stuff is in the short term. Trust me. All that stuff is in the short term. And I'm going to give you such a ridiculous amount of resources why the accusation is a fact. Since the 1950s till now, the market has only gone down in a drawdown in a bear market only about 24% of the times. What that means is that 76% of the times the market has been going up. It's been always going up. You could say that, okay, then I will be profitable being net bullish than net bearish. Exactly. right? The bears can look very smart in the short term, right? A person can predict a crash and they're going to look like geniuses, right? But if they keep doing that over 10 years, that person's going to be very poor. That person's going to be very stressed. They might get cancer in 20 years because why you're think about it, you're using a system in where you have a 24% probability that the market does not go down. And that has to do with the country and economy that you're investing, right? I strongly recommend for anyone who doesn't invest or doesn't have a lot of experience in investing to just stick with American companies, right? Or areas of companies that you're competent at. But most of all, we're going to focus on American companies because fortunately enough, American companies have a track record, and until now, they're still very, very strong, right? The United States can definitely grow in a ridiculous amounts for 30 to 50 years. I don't know about in 200 years. I don't think many people are going to be here for 200 years, but there's even factors that I'm going to teach about that too, right? I'm going to really cover so many different ways because fortunately I was able to invest many different investors that have a different way to go about it. But at the end of the day, they have one thing that's similar, that they invest in companies that are very strong and they don't invest in a company because of their stock. And that's why Ray Dalio, Mark Howard, Lee Lu, Warren Buffett, Charlie Munger has stayed so consistent and has made so much money in over time because they've invested in very strong companies that people weren't investing in. Rather, people were investing in things hypely because of a stock in return in 4 years. I don't want you to do that because that never lasts in the long term. I want you to really grow your wealth. I don't want you to be rich. I want you to be wealthy. Wealthy always maintains itself and it grows in assets as time goes on. The rich person can have a lot of liquid cash in the short term, but maybe in 3 years their net worth has gone down like 80%. Like that's very stupid, right? That's not the point here. I'm not going to be teaching you that. In the next lessons, we're going to be talking about a bit more specific information about investing.